46.7. That's the weakest since May of 2020. And finally, on the composition of all the PMIs, 47.5. Also the weakest since May of 2020. These aren't good numbers. They're preliminary. In a couple of weeks, they may change, but they do give us some insight as to why interest rates may be going down. Currently, the 10-year is down 10 basis points on the day. It is down 14 basis points on the week. Squawk on the Street will return after a short break.
It is time for the bond report. Let's give you a quick look at how treasuries are faring this morning. You can see yields down across the board, and that 2-year, 10-year, that's still got the 2-year well above in terms of yield. We'll be right back. Well, prices, you see up today, remaining volatile, weakening demand, tighter supply. The latest. Joining us to discuss is Citi's global head of commodities research, Ed Morris. Ed, always good to check in with you, which we've been doing somewhat regularly. What are the latest things people should be aware of when it comes to the markets that you follow? Obviously, the key one being oil around the world.
I think two of the interesting things that are happening this week, even with the price bumping around as it has been, is that time spreads are coming in, particularly on WTI. That is the backwardation in the market, or the signal that the market is very tight, are now showing signs of looseness. And this is something to watch. The cracks or the profitability of making gasoline and diesel are also coming in, another sign that we may see some loosening up in the market. And of course, what this is reflecting in a way is where the summer has been to date when it comes to driving season. We're seeing virtually no driving season in the US, at least when it comes to data for gasoline demand. Gasoline demand is way down, a function of some combination of high prices and an economic slowdown that must be at work.
So interesting. So we've had that demand destruction that we all talked about was a possibility, I guess. I mean, what are your expectations from here?
Well, we think we're going to continue with that because the economy is showing signs of weakness. It's intriguing on the demand. Our gasoline demand and our diesel demand is lower than any year going back, other than, of course, the 2020 pandemic year, going back 10 years, 2012, 2013. And year on year, it's down for the last 3 weeks, about 1 million barrels a day. That's a sign that nobody really was anticipating. And it's a combination, I think, of where high prices are. It's also an indication that inflation might be coming down. We're seeing signs of that on the major grains as well. Wheat, soybeans, corn are all slowly going down. Gasoline prices have been down for like a month straight. So that's good for the consumer in the longer run for sure.
Ed, I know you moonlight also as a part-time meteorologist, or you have to for your job. What's the impact of the hot weather across the globe, as well as the potential for hurricane season, which is quickly approaching?
Well, here you really are going into where we have to go, because while we are seeing a slowdown in demand, we're seeing horrendous weather conditions. We're seeing the hottest weather in the Northern Hemisphere ever. That includes China, North America, as we well know, wherever we're sitting in North America, and in Europe. And look at London with 38 degrees centigrade weather. We're seeing a hot, dry weather that is bringing electricity prices up everywhere in the world you can look. We're seeing blackouts everywhere in the world you can look. And these are not going to end anytime soon, given the expectations for hot weather, particularly west of the Mississippi, for the remainder of the summer. But then, as you mentioned, there's a hurricane season, and it's the real wild card on the pricing side. We normally don't have the third named storm until August 3rd. We had the third named storm in the month of June. We've had the 9th named storm already. So we've been kind of relatively free in the Caribbean, in the Gulf Coast of the US, and the East Coast of the US so far. But with a prediction of 24 named storms, 3 to 6 Category 3 or higher hurricanes in the forecast, we have to watch out, because this could bring down U.S. production in the Gulf of Mexico. It could bring down the refining system in the U.S. Gulf. So it is the wild card that we have to look out for.
Ed, always good to check in. Appreciate it. Thank you.
Thanks for having me again.
When we come back, more reaction to those results from Snap. Of course, it isn't good. You can take a look at that right there on your screen. And remember, Jim Cramer, well, he'll be back Monday morning. Good Friday morning and welcome to another hour of Squawk on the Street. I'm David Faber with Leslie Picker. We are live from Post 9 right here at the New York Stock Exchange. Carl has the morning off and Morgan is on maternity leave. Let's give you a look at the markets and where we stand right now. Well, NASDAQ, been kind of clawing its way back briefly during that first half hour of trade, but we are now sort of towards the lows of the session with the S&P down 0.25%. Leslie.
Yeah, seems to be following the trajectory of its other big index peers. We're 30 minutes into the trading session. We'll get to Snap and Twitter in just a moment, but here are three other big movers that we're watching this morning. There are many, actually, starting with American Express, rallying after beating on the top and bottom lines. Card members registered record spending driven by a rebound in travel and entertainment. That stock up nearly 4% this morning. And Mattel falling despite a better than expected quarterly performance and strong sales of movie-themed toys. However, sales of its American Girl brand slid nearly 20% during the quarter. That's leading to a stock slip of about 2.7% currently. And Verizon looking kind of similar, falling after earnings fell short of estimates and the company cut its full-year forecast. That stock now down about 5.5%. Verizon is seeing its phone subscriber growth impacted by higher prices. We'll have more on those results later this hour as well. So got to stay with us.
Yes, you do. First, though, we're going to get to a couple of those stocks that, or at least companies that are seeing significant slowdowns in their ad sales, and they are Snap and Twitter. Both the stocks are also down. Let's get to Julia Boorstin for more. Julia.
Yeah, those two companies painting a grim picture of the digital ad landscape, and we see both of those shares falling today. Twitter reporting this morning disappointing street estimates across the board, blaming ad industry headwinds associated with the macro environment, as well as uncertainty related to the pending acquisition by Elon Musk, also citing that Musk deal is the reason why the company is not giving any guidance or hosting a conference call. The company reporting an 8-cent per share loss instead of the 14-cent per share gain that analysts had expected, while revenue in the quarter decreased 1% from the year earlier quarter, falling 11 percentage points below estimates, which makes this the biggest revenue miss that Twitter has ever reported. Baird writing, quote, advertisers are shifting ad budgets towards more measurable and reliable formats, which we believe favors larger scale and direct response platforms. Snap, meanwhile, that stock plummeting today, drawing at least a dozen analyst outgrades. You see shares are now down 35%. This is after that company also reported disappointing advertising, missing on the top and bottom line with 13% revenue growth in the second quarter. And the biggest disappointment of all, so far in the third quarter, the company says revenue growth is flat with the year ago period. That's a sharp contrast to the 18% growth that analysts were forecasting for Q3. CEO Evan Spiegel blaming the shortfall on platform policy changes, namely Apple, macroeconomic challenges, and growing competition for what he sees as a shrinking pool of ad dollars. He says they're substantially reducing hiring and reprioritizing goals and initiatives across the company. So now the question is how much these two companies are bellwethers for the rest of the ad-supported platforms. Alphabet and Meta report next Tuesday and Wednesday, and then Pinterest reports on August 1st. All of those companies are trading lower this morning. Leslie?
Yeah, Julia, those are very key questions. Thank you. We know you will be all over this and have much more later on Tech Check today. But for now, let's bring in Justin Patterson from KeyBanc Capital, one of over a dozen analysts that Julia mentioned that are downgrading that stock this morning, now with a sector weight rating. Justin, what changed? What did the quarter tell you that made you say, yeah, can't do a buy anymore here?
Yeah, thanks. Really, the thesis is broken on this one. So the bull case on Snap with that this is a budget, a share gain story, would attract more budgets from advertisers due to the measurement of ads being very effective. And what's really happened here is that Snap has had difficulties around these platform changes. It's frankly been a beta play on just ad budgets increasing, as we've seen ad budgets really start to go flattish and even contract in some sectors. Snap is now losing share to more effective channels, whether that's Meta, Google on one side, and TikTok and Apple on the other. So when we look at the growth profile going forward, this is probably a 20% grower at best. free cash flow, gap profitability pushed out far into the future, that it's difficult to justify staying with this one.
So, given all of the factors that Evan Spiegel blamed, that Julia just outlined, macroeconomic, privacy changes for Apple that had cut into the way that they're able to collect advertisers, the competition, the shrinking pie among advertising dollars that they're experiencing right now, what is it that Snap can actually do to turn this business around, given those factors that, at least from the face of it, seem largely out of their control?
Yeah, it's a great question. And if you look at just ad agency results the other day, those were actually fairly reasonable. Snap is now growing below ad agencies, which you don't really expect to see for a secular growth business like this one was supposed to be. So it really has to be a function of both R&D and sales and marketing investment, which paints the picture of the challenge Snap faces. It has to reduce OpEx a bit to deal with the slower revenue growth, but it can't cut too deep because then it sacrifices potential market share gains in the future. So really, the company's at a rock and a hard place from our perspective here.
Justin, I'm just looking at your 3-year rating and price target history. I mean, you've had this as an overweight as low as, I think, $29, as high as $88 or $90. You finally downgraded it today. Explain that, sort of. Why not just stick with it, given you've been high and low on this thing and had the same rating for a long time?
It's a fair question, and I'm certainly not alone with that this morning. Really, the thought here was that Snap had done a good job on the measurement side, was dealing with competition effectively, and results last night changed that. You're seeing Snap now specifically call out competition when agencies are actually devoting more budget to TikTok at the same time. That the question that I think is in a lot of our minds right now is, if Snap is growing basically zero into the July period right now, how much worse could it get if and when macro factors intensify? Recall this one back at the onset of COVID was actually still growing in the teens in that April timeframe. This is a worse result than when the world crawled to a halt back in April 2020. So there's a lot of questions on what this looks like going forward, and it's difficult to justify staying with this. I'd have to argue for multiple expansion, and that's something I don't have confidence in, given the results and given the uncertainties.
Okay. You mentioned competition and TikTok. Obviously, we don't have as much visibility there. ByteDance is a private company. What is your sense in terms of TikTok's, growing dominance or ability to be taking share, I guess?
Yeah, it's a really good question. If you look at most ad agencies, at least in our checks, we've generally heard a lot of agencies talking about shifting budget levels from about 5% of digital spend to, sometimes as high as 20%. So that does take away from the pool of dollars that is available to Snap. It does reinforce that the Spotlight product, the TikTok competitor, is very late to market, and paints a picture that it's going to be difficult to gain some of that budget back. The other issue that I think myself and a lot on the buy side are working out is, has TikTok flooded the market with impressions, and that's creating price headwinds? So effectively, ad supply increases, that dampens the price an advertiser is willing to pay, and that creates some structural challenges. If you look at China, the ByteDance effect there was roughly, call it an 18-month to 2-year headwind for some other businesses there that I'm now digesting whether that same phenomenon is occurring with Snap here.
What do you think about the prospect for consolidation here? I think Snap has 3 classes of shares, so it's not something that would be a hostile situation per se. But given just the overall challenges, the overall competition, do you see any possibility of certain tie-ups taking place, or is antitrust just something that would prevent that altogether?
Yeah, it's a great question, especially in the wake of Elliott coming in on Pinterest recently, and then the ongoing drama with Twitter and Elon Musk. To your point, the share structure is a challenge. The bulk of voting control is concentrated in the 2 founders. And generally speaking, it's rare for a founder to give up on a business when they are still anchoring on last year's prices and investor sponsorship. So between the ownership structure and antitrust concerns, no large tech company can really buy this asset. I don't think M&A is a possibility for activism. What I do think, as a broader read to the overall group, is that you are going to see a lot more internet assets get scrutiny from investors, from activists, since the COVID tailwinds have clearly faded out. And there's a lot of capital allocation questions. Are expense structures appropriately managed? That I think you'll see a lot of companies slow to adapt to.
Yeah, they gave him a pass for a while when the stock prices were doing well, and now they're going to be a little bit more critical. It all makes sense. Thank you, Justin.
Thank you.
Well, President Biden, as many already know, testing positive for COVID as the Omicron variant continues to drive a summer surge in cases. The president was said to have, quote, very mild symptoms. Our Kayla Tausche joins us now, and she has more for us. Kayla.
David, the White House COVID coordinator, Dr. Ashish Jha, said we should know within about a week which variant of COVID President Biden has and whether it's that new ultra-contagious BA.5, which now represents about 70% of all cases here in the U.S. This morning on the Today Show, Dr. Jha said the president feels fine and that he's being closely monitored to make sure his condition and any side effects from stopping existing prescriptions don't become more severe.
He has a personal physician who is checking in on him regularly, getting regular vital signs, as one would get with anybody, and so that's the main thing. And his personal physician's also consulting with infectious disease experts around the country.
The White House continues to convey the president is healthy and working. This morning, his official Twitter account posting this photo of signing a bill into law yesterday that suspends tariffs on baby formula to try to alleviate that continued shortage. The White House has not been able to pinpoint where the president contracted the virus, given his many engagements here and overseas, and the high community transmission nearly everywhere. Chief of Staff Ron Klain, considered a close contact of the president's, said West Wing staffers are testing regularly to try to contain any spread.
So far, we're monitoring the close contacts to see if any test positive. We'll see, particularly here at the White House, what the test results are tomorrow. But so far, we don't have any positive test results that are linked to the president's case.
Today, the president plans to meet virtually with his economic team to discuss inflation and also with his top advisors to discuss any progress moving their agenda forward on Capitol Hill. David?
Thank you, Kayla. Kayla Tausche. As we head to a quick break, let's give you a look at our roadmap for what remains of this hour, including talking about shares of Verizon. They are down after the company cut its full-year forecast. They had a big miss on subscribers. We'll get to more of those results.
Plus, decades of affordable energy is coming to an end, even more so than it already is. We'll explain.
And we'll have the CEO of Freeport-McMoRan with us on the, quote, striking shift in the copper market. That metal up this week, go down more than 30% from the March high. Got a lot ahead for you here on Squawk on the Street. Don't go anywhere.
Welcome back to Squawk on the Street. Let's take a look at shares of U.S. telecommunications, ETF ticker IYZ, down 20% since the beginning of the year, currently down a little more than 1%. Two key holdings under pressure post-earnings, AT&T continuing to trade lower despite yesterday's beat on both the top and bottom lines, and Verizon also moving lower on that company's earnings results out this morning. Verizon shares down 5.8% right now, shares dropping on those weaker than expected results, the company cutting its full year forecasts as well as higher prices weigh on phone subscriber growth. We talked about the higher prices last hour. Subscriber growth in key for Verizon, cash flow in key for AT&T. Neither picture looks that pretty.
No, I mean, yesterday AT&T shares were down sharply after the company reported very strong subscriber growth, over 800,000 additions. But there was worries about their cut in their free cash flow guidance. It had been $16 billion. They went to $14 billion with an expectation of about $10 billion in free cash flow for the second half of this year. They cited a couple of different reasons. One, more devices going out of the stores. That means more subsidies potentially. So that used up some cash. And then as well, people paying their bills a little later than had been anticipated. So that was sort of a working capital question as well. But here it's much more about 215,000 fewer subscribers in the consumer postpaid, which is what we watch. Consumer postpaid subs down to 15,000. Expectation, I think, had been for as much as 125,000 higher. And then obviously the cut in the EPS outlook for Verizon and the revenue outlook as a result of that. And to your point, you know, I'm reading an analyst report here, thought price hikes might offset subscriber pressures, at least when it came to earnings. But they thought there was a chance they would be able to increase revenue and EBITDA growth as a result. In fact, they lowered guidance, suggesting the pressures are likely to continue.
Both in recent years have disposed of their advertising exposure, right? With the sale from AT&T to Discover of its media assets, and Verizon sold its media assets to Apollo.
Yeah, with Yahoo
So
Finance.
all of the advertising concerns that we've heard this morning, not necessarily the case with these two companies.
No.
It looks more like a commodity in that sense, in that consumers are having a hard time either paying their bills on time, in the case of AT&T, or signing up for Verizon without those discounts.
I would note shares of T-Mobile are up. We're going to hear from that company next week. And it has sometimes been an outlier when it comes to the big two, and then T-Mobile managing to put up numbers on both subscriber growth and EPS that are better than had been anticipated. We'll see. But that stock now the lone outperformer in the group. I should say the lone stock of the big three that is in positive territory for the year, up over 15% still are shares of T-Mobile. You certainly wanted to own them. AT&T, by the way, is about flat for the year. All right. When we come back, we're going to have the CEO of mining giant Freeport McMoran this after reporting profit and revenue that did miss expectations. Going to want to hear what he has to say about a strong dollar, of course, which has been weighing on commodity prices. And they've got a great look at the global economy as well. We're back after this. Copper prices rebounding a bit from what had been recent lows. Back on July 6th, it was trading at levels we hadn't seen since November of 2020. Now, the drop in prices hit shares of miner Freeport-McMoRan, saying on its second quarter earnings call yesterday that while it was a sudden and unexpected decline, there has been no impact on physical demand. Joining us now is Richard Adkerson. He's chairman and CEO of Freeport. Richard, always good to have you, particularly in this, I mean, I don't know, this is kind of a weird environment that seemed to come through on the call as well. You know, this dramatic decrease in price. What do you make of it, and what does it say about sort of how you do your long-term planning?
First of all, we have to live in the short run. The market's the market, and our prices are down. What's different, this is the third decline we've had in the last 15 years. There's been rapid recoveries from each of the prior three, and we managed our way through it. What's different this time is a huge disconnect, David, between the physical market and the financial market. These lower prices are truly anticipatory. People are expecting things to get worse. In our business, they haven't yet. Our day-to-day business is the same now at today's copper price as it was when prices were approaching $5. Get this, even with the drop, global inventories dropped slightly during the quarter. So it's a big disconnect. If things get worse and there's a global recession or stagflation that I hear you talking about every day, then this price will be justified. If the future is better than as anticipated, watch out, because the market is really tight.
Interesting. Yeah, well, you said on the call as well, you know, listen, the way this thing is priced, it looks like future demand is going to potentially drop off a cliff. No way to know, Richard, but give me your guess. You know, in terms of, you come on many times and talked about all the uses for copper, how healthy the future is overall. But give me your guess here that the market seems to be saying, hey, the possibility of a recession is strong and that demand will, in fact, drop off a cliff.
Let's save some time for the long term. But looking at the short term, David, all these years I've had in the natural resource business, I've disciplined myself not to make guesses. We work on scenarios. We got a plan in place to deal with the scenario of near-term further price weakness. We have a plan in place of dealing if things are better. But I just don't guess. I don't allow myself to. Quite frankly, I don't want our people guessing. We need to know what we're doing, and we do.
Right. That said, you have slowed capital spending, right, at a slower pace than your original plans, correct?
Yes. That stress testing we do is the first step, is to deal with capital spending. Our projects are flexible. They're not going away. We don't have to spend money now. The next step is to adjust operations to drive costs down further. Our net cost of copper this quarter was $1.41, as we predicted. It was a really strong quarter. The only miss had to do with some analysts not taking into account copper prices as quickly as they should, and that's understandable because of the changes. Operationally, we did great, but listen, it's a big deal for our company as leverage to copper to have to face the drop in revenues and the drop in cash flows when the price goes from $5, today it's $3.30, but it was lower. And so we have to be nimble and prepared.
Right. Well, I remember, and I know you remember, of course, going through a period that was a lot more difficult than this one when it came to your balance sheet. On that front, Richard, do you need to raise any new capital in this current environment?
No. We've got our net debt, David, is $1.6 billion. $600 million of that is dedicated for a smelter we're building in Indonesia that we committed to the government to build. It's separately financed. Just over a year ago, we set a financial policy with a targeted debt of $3 to $4 billion. So our debt is $1 billion now. And that is the major change, David, from past in Freeport. A lot of history is why it happened. And some of it was unfortunate. But this time, we go into this with a real strong financial situation. And What that does is avoids us from having to do new financing, selling assets, selling equity. We can manage our way through this. And look, I'm even more confident about the future than when I was the long-term future when we talked 3 months ago.
Right. Well, on that long-term future, Daniel Yergin joined us recently. He said copper demand is going to grow from 25 million tons today to 50 million by 2035. And he says that, in his opinion, that will be sustained at that level. Power and automotive applications have to be deployed at scale by 2035. You've talked about that, Richard. Do you still believe that to be the case as well?
Well, and Dan, who I've known a long time and have great respect for, Dan that is based on the world moving towards its goals for carbon reduction. And so the questions about the movement, boy, there are lots of challenges, as you know, a lot more questions than answers, but we're committed to it, and business and companies and civil society is committed to it. To get there, you're just going to have more copper. It's electrification. 70%, almost 70% of copper goes in electrification. And the supplies just simply aren't there. And there's no line of sight as to how supply can meet that demand in that time period. And so what that means is there's got to be scrap recovery, there's got to be conservation, there's got to be substitution, there's got to be some new mine development or expansions. That takes years to do. But all of that, if those goals are met, and if the world just doesn't fall off an absolute cliff, a higher copper price in the long run is inevitable. It just cannot, you cannot define that scenario without saying what Dan said, that there's going to be a significant deficit in the copper markets. And so that's why, with all this going on around us, with this big drop currently, we're even more firmly committed to our long-term strategy of being the world's foremost copper company. And what's happened this last month is even bolstering that long-term future, because companies have less revenues and more risk. So that means less investments.
Understood. Richard, real quick, you always give us some insight into China as well. I mean, last year it accounted for, what, more than half of global refined consumption. What is going on in China? Can you figure it out?
I spend every day thinking about it, talking to people. With our business, there was an effect in demand from COVID lockdown and supply chain issues. That was offset by some supply problems in Latin America. Since, I've been CEO since 2003. During all that period, there's always been consistent predictions of Chinese demise. And while there are obvious issues they face, the country is large, hardworking people, and they're critical to the world's economy. They made some commitments to recover. There's some good signs coming out right now. There's no copper inventories that I can find that have built up in China. There's no unusual commodity trading going on in China. We're selling all the copper we produce globally. I said yesterday, our day-to-day world doesn't feel any different today than it did when copper was $5, and that is unusual.
Yeah. Richard, always good to have you. Have a great weekend. Thank you.
You too, David. Enjoy your vacation.
Thank you.
As we head to a quick break, speaking of vacation, a look at the S&P gainers as we close out the week. More Squawk on the Street ahead. Don't go anywhere.
Good morning and welcome back to Squawk on the Street. I'm Bertha Coombs with your CNBC News update at this hour. New York Republican candidate Lee Zeldin was attacked by a man wielding a sharp object at a campaign event near Rochester, New York. Zeldin was not injured and no other injuries were reported. The 43-year-old suspect was charged with attempted assault in the second degree, a felony, before being released from custody. California Governor Gavin Newsom signing a series of gun safety bills into law amid the push for tighter gun controls in the wake of mass shootings across the United States. Among the 8 laws signed in is a 10-year ban on gun possession for those convicted of child abuse or elder abuse. And convenience store chain 7-Eleven cutting nearly 900 corporate jobs in the United States. The move comes roughly 1 year after the company acquired rival convenience store Speedway for $21 billion. The company has recently come under pressure for its performance from the San Francisco-based investment company Value Act Capital. David, back over to you.
Thank you, Bertha. Well, we are just over an hour into trading. Let's get over to Bob Pisani, see what's going on. Bob.
Yeah, flattish, sort of middle of the morning here, but a great week. S&P's up.
Listen to me. Once you realize who you are, you stop operating in desperation. You stop saying yes to stuff you ain't supposed to be saying yes to. So here's my big problem with a lot of y'all is your belief system is off. Like, everybody can see how sweet you are. People are commenting on, well, you could do this and you could do that, and you the only one ain't caught up with it yet. Gee, why you always on beast mode? I'm shocked more people are on beast mode. There are people who living from check to check and they comfortable. It's the weirdest thing to me. I'm like, boo, you broke. And you broke on several levels. We're not talking about Sally Mae. You still owe your grandma. We're talking about you need to cash your grandma out. Listen to me, unless you number one in your industry, you shouldn't be chilling. And if you number one in your industry, you got enough common sense to know you better not be chilling. Every single day of my life, I feel like giving 120. Every single day. Somebody said yesterday, E.T., you gave 120. What you gonna do tomorrow? I said, I don't know. Give 140. I don't know, but I don't have days where I don't feel like it. Why? Because I'm counting on me. My wife's counting on me. My son's counting on me. I don't have days to waste. There's nothing wrong with the opportunity. You're not giving 120. You're giving 70. You're giving 60. You're giving 50. And you want what these people who've given sweat, who's given blood, who's given tears, you want what they paid for, and it ain't free. You don't belong at the bottom, and it's time for you to get your butt from down there. It's time for you to stop being comfortable at the bottom. Get your butt up and get to where you're supposed to be. The Bible says he was in a pig pit and he came to himself and he went, get your butt up. You are a royal priesthood. Get where you belong. Do what you're supposed to do. Live like you're supposed to live. You got all the stuff. You got it all. But you will not outwork me because your height has nothing to do with my work ethic. Your face has nothing to do with my work ethic. Your give up when you don't. My life. You doing you have to see it when nobody else sees it. You have to feel it when it's not tangible. You have to believe it when you cannot see it. You gotta be possessed with the dream.